Welcome to TheoTrade. This is Don Kaufman. It's October 6, 2018, and you are watching the TheoTrade Weekend Update. Let's start with a quick week in review, then move forward and really get into right up front what matters most in this marketplace. First and foremost, bonds are clearly in the driver's seat. So what does that really amount for you? Well, first of all, to start a discussion about bonds, not everybody that tunes into TheoTrade or that's in markets as a whole necessarily has any relationship with bonds. Meaning that, hey, listen, you're worried about what stocks to pick and so forth, and bonds are not necessarily like on your radar screen on a day-to-day basis. But there's a few aspects about bonds that you need to be fully aware of at this point in time. First and foremost, let's even put interest rates aside, because that's what's causing a little bit of the fear this week, but put it aside for just a moment, right? Interest rates are climbing. Hey, that's easy, right? That's secondary news. The point with bonds right now has to do with what we term a positive and or negative correlation. And this is the big and differentiating factor in this last week of trade. Allow me to explain. First and foremost, we are coming off about a 20-year cycle where the relationship, again, what we term a correlation, okay, has been negative between equities and bond markets. What does that effectively mean? Well, it means if equities are going up, that's the market, right? If S&Ps are rallying, effectively bonds are doing what? Selling off. Now, over the past 20 years, as I mentioned a moment ago, it's about a 20-year cycle. Over the past 20 years, that kind of inverted correlation, or what we term negative correlation, it's been negative 0.66. So it's pretty definitive. Again, if the S&Ps are selling off, bonds have been going up. It's been a nice, hedge as well. You think about over the last 20 years, anytime the market's seen a pretty ugly bout of volatility, what could you do? Well, fund managers and big hedge funds and so forth, and anybody managing capital, when the market started to get volatile, all right, and the S&Ps started to see some degree of volatility, they would run into the bond market. And it was, again, this nice kind of clean hedge. Well, what's the differentiating factor right now? Why do I say that bonds are in the driver's seat and you really need to pay attention? Because the correlation right now is astoundingly positive. This, does not bode well for either equity markets, it doesn't bode well for bond markets, and it definitely isn't good for mom and pop investor with a 401k, because right now there's nowhere to run to. And we get like this diversification, desperation. And what that means is we just saw this 2-day period that we're coming off where the S&Ps started to sell off. Bonds clearly are getting rocked to the downside. So all of a sudden, this 20-year cycle where we're like, all right, the S&Ps are down big, everybody runs into the bonds, that's not going to work. And it is the single most important factor right now moving forward. Put aside what you might think about Apple or Tesla or any of it, Because what is going to make all the difference in the equity markets moving forward, is big capital going to feel uneasy, about the ability to hedge their risk moving forward. Again, one of the key hedging factors is that rotation from equity markets into bond markets. And I'm going to elaborate upon this in just a moment when we start to take a look at the charts, because we're seeing these wild rotations in sectors that just don't make any sense whatsoever. Except when you recognize these rotations, are a product of this now positive correlation between equity markets and bond markets. With that, let's take a look at the charts. We're going to go through a lot of detail, a lot of data, and a lot of very specific trades. All right, let's get into some detailed analysis, specifically here on the bonds versus the S&Ps. Now, in terms of the bonds, there's a lot of different things you can look at, right? You can look at the 10-year, you can look at the 30-year. In this particular case, just to make a point, I'm going to use the TLT. All right, why am I using the TLT? It's a good proxy. It's a nice ETF kind of proxy between the, the TLT is the 20 year. It's right between the 10 and the 30. So again, great kind of proxy for it. What you're looking at specifically is right down here. Well, yes, that happens to be the TLT. What does it stand for? All right, that happens to be like 20 year, and it comes down to bonds. All right, so there's your bonds. Up top over here, we happen to have the SPX. And now, again, in most cases over the last 20-year period, all right, the correlation has been about negative 0.66. What that effectively means is, when the when the bonds go up, the S&Ps are going down and vice versa, right? Here's actually the bonds going down, the S&Ps going up, and that's a negative or an inverted correlation. All of a sudden, more recently, what do we see here? SPX down, bonds getting absolutely rocked. The big question mark, is that going to continue? Because what that means is, and this is the part of trade that a lot of people, they just don't get on the retail side. Okay, and just to explain it, if you are managing money, large sums of money, where does the money go? And everybody goes, oh, it can go into cash. Well, I'm sorry, it cannot go into cash, because when you're managing a few $1 billion, that just doesn't suffice. So you have to rotate capital somewhere. And what we saw right in this neighborhood when we got this positive correlation, again, we see the S&Ps getting whacked, we see the bonds getting whacked, we see almost like this, what I'll term diversification, like it's becoming desperation. So where do you go? Well, again, I'm going to snap out of here for just a second. You see, again, the bonds kind of selling off. And to point this out, we're going to cruise over and we're going to look at, this is the S&P 500 sector indices. And this one, I mean, I'm still perplexed by it. So this just happens to be yesterday, which was, Friday, October 5th's trading session. And all that you're looking at is just a spectrum, again, of the S&P 500 sectors, most of them, of course, being down. One of them is a real standout, right? What is the sector that is the real standout? And again, no matter how many times I look at this, I'm talking right here. What's the big standout on the screen? It's none other than the utilities, which to me doesn't make a whole heck of a lot of sense. And this is why, again, you're going to get a marketplace that now opportunities are really going to start to open up. So if I pull up something like the utilities, the XLU, let me tell you why it doesn't make a whole heck of a lot of sense. Okay, the XLU pays a 3.5% dividend. If you take a look at the XLU, all right, well, it rallied pretty substantially both on Thursday and Friday of this past week. Why am I questioning it? Well, why do we run into utilities, okay, if the bonds are going to effectively pay us a bit more? Meaning that if you look at a bond, look at the 10-year, go over to the TNX, okay, the TNX now is actually shot all the way to 3.25%. And I'll kind of label that over here. If you've never looked at this, the TNX is the representative of the 10-year Treasury Index. It's trading for 3.25%. So the question is, why would you rotate your capital, okay, out of the S&Ps into the XLU when the XLU, it's somewhere around 3.5%? Is it a little bit better than the bond? Yeah, but in the XLU, you actually sustain equity risk, right? The XLU can go up or go down. So again, there are moves being made, okay, by individuals with billions and billions of dollars of capital that make absolutely no sense whatsoever. And that's, again, this is a time, okay, where you got a mark in your head like, all right, there's going to be some opportunities opening up here, okay, because even large money is in a little bit of a state of confusion. Now, the other aspect that I think is critical to point out is that we saw some pretty good sell-side activity both Thursday and Friday of this week. We haven't seen some sell-side activity in quite some time, but that sell-side activity was not in any way, shape, or form met with correlation in the S&P 100, okay? So here's the S&P 100. When you're seeing the S&Ps, and these S&Ps, okay, again, even yesterday, they were down and down big. When those S&Ps are down 30, or when they're down, for instance, 40 on a trading day, you want to see that advanced decline like being 90-10. We got nowhere near that. All right. There's no correlation to it. And part of this kind of chaos and this sector rotation is all about, again, it's about the bonds. It's about the bonds selling off with the equity markets, and it is driving right now confusion. So stop right there. What are some areas that you really want to consider? Well, one of the first things that you want to think about is, okay, are the bonds going to continue to sell off? Okay, are rates going to continue to rise? Here's pure opinion. At this point in time, I think we've seen a pretty ugly bond rout. Now, just a heads up, this Monday is going to be Columbus Day, and the bond market is effectively closed. So you're going to see equities trade without the bonds, which should be interesting, okay, to say the least. So with that, it's going to give you a little bit of time to think. Again, pure opinion in here. What I think we're going to see inside of the bond market, okay, possibly mellow out, pop back up. But overall, I do believe that these bonds are going to be on a trajectory to the downside. Maybe not as fierce of a down move, okay, as we've currently seen. This was a shot across the bow. This is a warning signal. Interest rates are going to go up, period. Now, what can I hop on in terms of trades when interest rate environment is rising? Now, people, I have been talking about a rising interest rate environment since early January, and we've been hopping on trades since early January for a rising interest rate environment. And you're like, well, how did you know? I don't know. The Fed told me. I mean, come on. The Fed told me that we're going to raise. We're going to raise multiple times this year. What, did you think the marketplace was going to sit back? Okay. Eventually, the marketplace was going to snap and rates are going to explode higher. That's what this really amounted to when the bonds broke off that 140 level. But nevertheless, okay, just do what the Fed is telling you to do. We are going to raise rates. And again, if when it comes to Jerome Powell, he did a speech earlier this week, which probably that speech really kicked off some of the sell side activity. He's like, hey, we're far from neutral on Fed policy, which means they got to kick rates into high gear. They got to get them up even further. So at this point in time, all right, you got to pick and choose, like, all right, where am I going to go in? Now, I'm going to show you some aspects and areas that I feel are going to be really, really appropriate. I've been talking about these extensively, okay? And 3 weeks ago, even did like a weekend video that said interest rates are going to be front and center again. Nobody's going to worry about a trade war. You're not going to hear about any of that. We specifically said interest rates are going to be front and center, not just because of the Fed, okay? Simply because what? Okay, interest rates are already taking their toll in specific sectors. So I talked a lot recently about the home builders and XHB, and this is one that we were short for an extensive period of time, obviously breaking down. Now, in the home builders, I would fully anticipate, okay, a bounce back to the upside. And to trade a bounce in here, I'm actually using a really, really short duration in the money option. That's it. All right. I'm just buying it in the money call, which is, I could have gone out and just bought the XHB in the short term, but I wanted to limit my risk because it's not easy to step into a marketplace that hasn't seen an uptick in umpteen days in a row. This is a very bold position that I am taking inside of the XHB. The position is only relevant, okay, for a few trading sessions. That's it. I just used, again, an in-the-money call as a proxy, okay, as a proxy for effectively the stock. So again, it's a when I say it's a bold position, I didn't want to step in and buy a $37 product, okay? But the irony is we went out and we were actually buying those calls, okay, kind of midday prior to this bounce back up. After about, 50 cents, a dollar bounce, I may elect to bail out. I'm not looking to sustain, okay, huge upside potential. All I'm doing in this particular case is looking for a decent bounce back. Hey, there's got to be an up day in here somewhere. All right, we get up to north of 38 though, and I'll knock out of those calls. But that's actually a bounce trade. It's a bullish trade inside of the XHB. But at this point in time, again, in a rising interest rate environment, you're hunting for trades. And listen, the home builders, that ship has sailed. And you can look through individual home builders. So I've been all over, okay, Lowe's and Home Depot. Now, Lowe's, let me actually pull up a year-to-date percentage because Lowe's is still up 20% on a year-to-date basis. Now, Lowe's is actually where I elected to put my position on. This is a short position. This is a short position inside of Lowe's, okay, looking for Lowe's to continue, okay, to kind of depreciate here over the next couple of weeks, couple of months. I expressed this very, very clearly. This is a duration position. This is not about 1 week or 2 weeks, okay? This is 3, 4, 5 months. I'll continue to roll a position. I was also looking to hop on Home Depot. Home Depot, though, I never got filled, and the thing absolutely got crushed. Plain and simple, Home Depot, the chicken is done, overdone at this point in time. I would not be hopping on a bearish position inside of Home Depot. Now, to kind of continue on that front, you'll notice that, yes, I am looking to short a number of positions other than maybe that bounce trade inside of XHB. So where else am I looking? Financials. Now, in this most recent kind of route in the bonds and this most recent volatility that we saw at the end of this week, the financials have remained, okay, what? Relatively unched. That's massively unchanged. And though we saw, okay, big ranges on the day inside of the financials. For the most part, where are they on the year? Completely and utterly unchanged. I think that there is still a decent trade in here, and it's very specific. It's JP Morgan. When you start looking around at some of the financials, and this is what you want to do, okay? Listen, I don't make a decision like, oh, look at the technicals in here. Listen, I got to look at individual products in comparison to the sector. This is about sectors right now. Citigroup's down about 2%. Done. I don't want to be involved in there. All right. Wells Fargo, forget it. It's already down 13%. Morgan Stanley, come on. We shorted this already. We shorted this and bailed out pretty much at the current price. Right? We literally bailed out a few weeks ago at the current price. It's down 10%. We rode that one down. Okay. Bank of America. Bank of America, it's only up 1% of the year. What do I want to be short? JP Morgan. What am I short? JP Morgan. So I've got, again, pretty good size position inside of JP Morgan. Again, carrying a short position. I'm the 125 puts. Why am I using puts to get short the stock? First of all, if you're in a retirement account, you can't short the stock. Secondly, okay, I'm using the puts as a proxy and limiting my risk by effectively doing so. So there's the JP Morgan position. Now, let's kind of continue on. You're looking at this marketplace and you recognize that interest rates, okay, are going to take kind of center stage. And you're also looking, again, opportunity. Where does it lie? A lot of opportunity lies over in the Dow. Okay. Why? The Dow is relatively unscathed. And the Dow, okay, over the last couple of trading sessions really got bid up. Right? Now, you might think to yourself, you're like, well, but I want to look at technology. I want to talk about Apple. I want to talk about Google. I want to talk about Amazon. I don't. And I'm going to tell you why I don't. So tech got rocked a little bit, right? You can see the volume in here. Absolutely astounding. For me, shorting tech, far too dangerous. Far too dangerous. And, you know, when it comes down to technology, listen, I don't mind saying, like, I'm not putting my capital at risk being long or short tech right now, because tech is an impossible, first of all, if you're into fundamentals, it's an impossible valuation. Oh, yeah, you know, that Facebook is really worth what? What's it worth? Okay, if Facebook was gone tomorrow, the world would be a better place, and everybody knows that that's true. But, you know, in terms of like a valuation, you just can't put one on most of these tech companies, including Amazon, and I would argue this into the grave. There is no easy valuation for it. It's incredibly difficult to discern how tech will play out, either with the trade war or how tech will play out, okay, when it comes down to higher interest rates. You just don't know. So make the world an easier place for yourself. And when I say make the world an easier place for yourself, go look, okay, at some Dow and Dow related products. And in terms of the Dow, there's a number of key products, and I'm going to bring up Boeing because I've brought this up a lot. All right. If you're looking like, hey, what can I take advantage of and possibly short that I can put valuation to? And I think Boeing is a very, very effective one. Now, granted, I have been and taken short positions in Boeing for quite some time. We laughed, we cried, we had good, okay, really good shorts in Boeing. We've gotten torn apart in Boeing. Nevertheless, if you're looking for what would be, okay, one of the key factors, if the Dow is going to fall, Boeing is that place that you want to be short. And you can't just step in and short Boeing. Come on, it's a $386 product. You got to go out here. You got to go out to the Novs. You got to go deep in the money, all right? At least the Novs. In fact, if you're going to short this thing tomorrow, I would come all the way out to the 76-day options, and it's not going to be cheap. You're going to have to get like an 85 Delta Plus. You're going to have to come in here, and you're going to have to put, $5-6 grand at risk to do one, all right? And that's okay, but it is one of the most advantageous areas, a number, of what I would term the largest Dow stocks are some really advantageous areas in a rising interest rate environment. A couple of other products that I want to talk about, because this past week, all of a sudden, everything we've been talking about for months all fell into place for us in a matter of a few trading sessions. Allow me to explain, okay? We've had short positions inside of XLY. I've been sitting here for like months, we're home. All of a sudden, some heavy sell side activity. My single largest position right now happens to be an XRT. Now, granted, most of the XRT positions are put on right around the 50 level. We're slightly in the money on these positions, and I got positions everywhere inside of the XRT, and I would expect that retail would continue to take heat. But you can't get short a product that's this deep in the hole. If you were going to get short in retail, you got to wait for a bounce, okay? We've actually carried short positions in the emerging markets. We've actually closed all the short positions right now in emerging markets because this has been wildly profitable for us. And I continue to sustain positions in FXE, which happens to be the euro. And I'm short inside of the euro. And again, had a wonderful couple of trading sessions, specifically being short the euro. Again, everything kind of falling into place. Note, I recognize that tech got rocked and I'm staying away from it. I want to reiterate that stance, at least at this point in time, because again, I don't want to run into an absolute firefight where I can't figure out what the interest rate component is going to be in here. Okay, all I know is that technology holds the key to the largest market cap, but at this point in time, it doesn't. Okay, from a risk-reward ratio, look to be the most advantageous area. Last, but definitely not least, okay, let's talk about the SPX. Why do we want to talk about the SPX? Well, we're going to take a look at a number of key aspects inside of the SPX. Obviously, we're always looking at what we term expected moves. Okay, and the expected moves kind of week in and week out. There we go. We turned them on. Let's kind of zoom into this and really kind of tighten up. Now, this one was pretty shocking to me. The expected move this past week was in the mid-30s. And the interesting irony is it held. It held, which tells us, okay, first of all, that in all the volatility that we saw on Thursday and Friday, markets are still incredibly efficient. Like you didn't hear me like barking about volatility at all. That's because markets are still incredibly efficient. That is, we came right down to the edge on the SPX. Take a look at this. When I say the edge, this is yesterday. This is Friday's trading session. That line across the screen over there, that's the bottom side of the expected move. Okay? You think the expected move doesn't matter? If you've ever had a question about the expected move, yeah, we stopped on the dime, rallied up, going up. I mean, because this was being defended. Okay, literally like the Maginot line over here. We bounced back up and we closed inside the expected move by a whopping $6. Now, the expected move has drastically expanded out, which is exactly what you would expect. So this next week, we're going to be riding, okay, on a big expected move, $48. Actually, one of the largest expected moves we've seen in any of the recent weeks, okay? This next week, it ain't going to be easy, okay? And I'm going to tell you what's not going to be easy. There's actually going to be a little bit of opportunity probably to sell some premium kind of early in the week. Because if you take a look, again, you start to open up, the option chains. There are first of all, Monday's expiration looks dead. About a $21 move, though, is being expected in what I term like a dead, expiration. Why? Because the bond market's going to be closed. So if you take a look at this, right there is only about 21, 22, but that's still fairly substantial. So we'll actually close that one up. There's a little bit of juice in here, people. I mean, between now and Wednesday, you got $37 of expected move. That's as good as all of last week. There's some juice to sell. But we need to see how things are going to shake out, probably coming into Tuesday with the bond market. Again, we are on a incredible run right now. You know, we're 25, 26 weeks. You can look at this the exact same way I am. There's 1, 2, 3 weeks out of all of this from beginning of April to right now. Only 3 weeks have we crossed outside of the expected move by the end of the week. It is the most efficient marketplace, okay, that we have ever seen. And in all the data that I've recorded, and by the way, when I say all the data I've recorded, I've gone back and I've looked at products like the spiders, okay, and I've actually put on auto expected moves, and I've looked back at years and years of data. Never have we seen the level of efficiency, okay, that we're currently seeing in this marketplace, which still leads me to believe, people, I'm taking again those outside shots, because when this market is ready to break, it's going to be Mr. Toad's wild ride. A lot to think about in this weekend's update. Thanks everybody for joining us here at TheoTrade. Join us the entire week. This next week, we're going to have a packed schedule. It's going to be important. There's a big inflection point coming in this marketplace. Thanks everybody. Have a great weekend. Bye-bye.